Good morning, everyone, and welcome to the Allianz D&O Megatrends webinar. My name is Senzile Ndlozi, and I'm part of the sales and distribution team within the Med and Africa region. Today is a special day with a number of financial experts who will be sharing with you their great insights from our annual Directors and Officers report, and it is an honor for me to introduce them to you. Our first speaker is Pauline Vacher. Pauline is a regional financial lines manager at Allianz. She's been with the company for 20 years and is an expert as she spent 10 years within financial institutions and 5 years within claims. Welcome, Pauline.
Thank you, Senzile.
Fantastic. Our second speaker is Vacher, who is the regional head of commercial management liability. Vacher is based in Paris and looks after the commercial management liability risk for almost 10 countries, both in Europe and Northwest Africa. Welcome, Vacher. Hello, Vacher, are you with us? Okay, that's perfectly fine. I'll move on to our third expert. Now, our third expert needs no introduction. She's been in financial lines within the South African sector for close to 18 years. Our senior financial lines underwriter, Amanda Banfield. Hi, Amanda. Good morning.
Oh, yeah, I haven't unmuted.
Amanda, are you with us? You have
Can
unmuted.
you hear me?
I can hear you perfectly.
Thank you very much for those kind words and good morning to everyone. Thanks, Senzi.
Thank you, Amanda. Now, before I hand over to the team of experts, a lot of the insights they will share in this presentation is actually reflected in our Allianz Risk Barometer, which was completed this year by 2,769 respondents spanning across 92 countries and 22 different industry sectors. Catherine, please can you move on to the next slide? Fantastic. Now, the interesting thing about the survey is that more than 10% of the respondents actually came from the continent of Africa. So we also had our say and input into what the survey determined. And what's quite interesting about this survey is that the top 3 risks is what we would term the COVID-19 trio. Now, the first risk that came up with 41% of the respondents is actually business interruption, including supply chain disruption. Next slide, Catherine. Thank you. And the second risk was pandemic outbreak and cyber incidences. The third is cyber incidences. My apologies. So now if you look at the number between 1 and 3, you can actually tell that the number of respondents who said these are their top of mind issues is relatively close. So business interruption came in with 41% of the respondents, pandemic outbreak with 40% of our respondents, and cyber incidences again with 40%, essentially telling us that these are the top of mind issues for most businesses in the world at this point in time, and that was 2021. The climbers within the Allianz Risk Barometer is in terms of market developments, macroeconomic developments, and political violence. If you look at market developments, it was sitting at number 5 last year, but it's sitting at number 4 this year. It's just climbing up 1 slot. With macroeconomic development, it also went up. Ranking in 10th last year, it climbed up 2 notches and it's sitting at number 8. Political violence also made it to the top 10, whereby last year it was nowhere in the top 10. In fact, it was sitting at number 11. Now, we've seen also 3 risks that have shown a downward trend, and that is climate change, changes in legislation and regulation, natural catastrophes, as well as fire and explosions. Climate change has been highly topical for many businesses over a lot of years. For us, Allianz, personally, we've been massively impacted by climate change. And as a business, we have taken the necessary steps to try and contribute in the climate change conversation. In terms of legislation and regulation, as you can see, it's a downward trend, meaning that businesses are not necessarily concerned as much about legislation and regulation at this point in time. With natural catastrophes, what's also interesting about them is that the downward trend is reflecting that natural catastrophes are not topical, first of all, but if you think about it, in 2020, we didn't have as many natural catastrophes as we had in prior years. So it hence why the downward trend. And then with regards to fire and explosion, you can imagine we are going through a pandemic outbreak. Again, we're thinking about the pandemic outbreak, the impact of cyber. We're thinking about business interruption and not necessarily focus much on the fire and explosion element of our risks. Anyway, let me stop with the risk barometer. For any one of you who'd like to access the risk barometer, please note that it is available on our website. We have tried to share it with the South African market as well as the entire continent. But if you cannot access it, please feel free to reach out to me. I will more than be happy to share it with you. We also have other social media elements you can utilize to access the risk barometer, and you can find us on Twitter as well at AGCS I will come back to you with our Twitter address. Now, as I close my introduction, I encourage you to make the session as interactive as possible and ask our expert any questions you want. So if you look on the bottom right-hand side of your screen, you will see a Q&A tab. Please tap on it and send us your questions, and I will gladly pose them to our expert. And the last thing I'd like to say is please enjoy the session and really have a fantastic time with me. Victor, the stage is yours, sir.
Good morning to all of you. Can you hear me now?
Yes, sir. We can hear you perfectly.
Great, thank you. I apologize, I have some trouble of connections. So thank you, Senzile, for the presentation of the Allianz Risk Barometer. People may wonder what this has to do with D&O market trends, but we will see that there are many connections. At AGCS, we have identified 5 major trends in the D&O market. We will first show that the economic environment is favorable to bankruptcies. Then Pauline will show you that the upward trend in securities class action continues. As cyber is everywhere, Pauline will continue the presentation by demonstrating that cyber attacks the boardroom. I recently had a meeting with a client in the oil and gas industry, and they asked me what can they do for D&O insurers to better address their risk. Client was surprised on my answers because I oriented the discussion on climate change and ESG factors. At the fourth megatrend, Amanda will show you the impact of diversity, climate change, and ESG factors on D&O. And I will present the last trend to show you that the private company exposure is still challenging. So, can you move on the slide, please, Catherine? Thank you. So the first megatrend to watch is global economic development and insolvency exposure. It's no surprise to anyone that the 2021 economic and political outlook is highly volatile. The world continues to suffer from economic downturn and a disruptive coronavirus pandemic. COVID-19 has a real impact on the financial structure of companies. It translates to longer payment delays and rising inventories among large corporates. According to ULRMS, global firms' liquidity needs increased by 5 days to 74 days in 2020. The economic environment has started to impact numbers of bankruptcies. According to Cornerstone Research, there were 6 mega bankruptcy filings involving businesses with at least 1 billion in reported assets during the first quarter 2020, 31 in the second, and 15 in the third, for a total of 52, compared with the 2005 to 2019 quarterly average of 5. The insolvency exposure will continue to grow in the coming months, years. According to ULRMS again, the bulk of insolvency is still to come. The top increases are expected to be recorded in the US, up 57 by 2021 compared to 2019, Brazil up 45%, China up 40%, and core European countries such as the UK up 43%, Spain up 41%, Italy up 27%, Belgium up 26%, and France up 25%. Why?
Victor, I think we're struggling to hear you.
Yeah, can you hear me?
Yes, we can hear you now. Carry on.
Sorry. Okay. So, why this bankruptcy increase are mega trend to watch for the D&O insurance? Because historically, insolvency is a key cause of D&O claims, as insolvency practitioners looks to recoup losses from directors. Stakeholders could go after directors following insolvency, such as alleging that boards failed to prepare adequately for a pandemic or for prolonged periods of reduced income meanwhile. Insolvency is one of the biggest intensity risks for the D&O insurer. I will finish that part by saying that one of the key concerns for D&O underwriters for 2021 is the impact of a gradual phasing out of temporary policy measures designed to support companies. Thank you for listening to me, and I will let Pauline speak to you about securities class action.
Yes, thank you. So good morning, everyone. As you know, class action are not really new in that space. And we can say that 2020 is on the continuity of the previous years. The number of class action have greatly increased since 2017, while before that period, on the previous 20 years, the average was around 200 securities class action per year. Since 2018, we have seen more than 400 securities class action. The impact is even more important when we know that the number of listed companies is decreasing year over year. Of course, 2020 has been a special year, as because of the lockdown of both business and courts, the number of class action was down by 80% compared to 2019, but we still expect this trend to go on. But while traditionally the securities class action was more driven by the financial disclosure, we see that nowadays the securities class action are more event-driven. And in that sense, the risk barometer is a good example. That means that nonetheless the financials are a point of attention for the D&Os, but also any kind of events can lead to a securities class action. We'll see in the coming minutes, and we'll have a word in the coming minutes about the cyber event or the ESG issue for the D&Os. We also have seen claims against firms that have made misrepresentation about coronavirus-related therapies, testing or equipment, and so on. Furthermore, we can say that not only the US companies are sued. It was nothing that the percentage of class actions against foreign companies has increased a lot in 2020. During the first half of the year, more than 30% of the litigations were against foreign companies, while before the average were around 60%. The main targeted companies are the Asian ones, mainly China and Singapore, with more than 50% of the foreign companies targeted. Then we also have the European ones, then the Canadian, and by the end, any other countries. Regarding the business sector, we can say that the main ones to be targeted are the tech one and the healthcare sector also. Meanwhile, new merger objection suits have been fewer this year than in recent past year, especially because the M&A activities are slowed down because of the pandemic. But on the other hand, the number of IPOs have increased a lot. And as such, we expect a potential for a wave of new IPO-related securities litigation. We have seen that approximately 20% of US IPOs launched between 2009 and 2018 gave rise to securities class action within the 4 years of the offering and more than 30% within the 8 years. We also see as a new class action threat the return to work steps taken by businesses. Employers can be in a tough spot when asking employees to return, and in particular on deciding which one to choose, and can be restricted by regulations regarding what they can ask and how they can act, which could bring problems. In addition, those companies which are slower to recover from the pandemic compared to industry competitors could leave themselves open for litigation from shareholders and customers. Last but not least, during this pandemic period, one positive legal development must be noted. Both the US state of Delaware Supreme Court and a trial level court in Northern California have upheld forum selection provision in corporate charters, which require shareholders to bring their actions exclusively in federal court for alleged violation of the Securities Act of 1933 related to shares offered in IPOs. That was an important decision, especially after the US Supreme Court of 2018, the Science decision, which affirmed the concurrent jurisdiction of federal and state courts over 33 Act claims. The companies decided to adopt such a provision in order to avoid both jurisdiction of the federal and the state court. As mentioned before, so we can go to the next slide on the cyber attacks. As mentioned before, it's quite interesting. It's an interesting trend regarding the class action in the fact that they are and even more event-driven rather than accounting-based. Any event mentioned before can lead to a class action. The main one is still the cyber event. It was the case in 2019 and it is still the case in 2020. During 2015 and 2016, the most common type of allegation related to accounting issues, with more than 30% of cases including this type of allegation. In 2018, case revolving around consequences of the #MeToo movement and the opioids crisis increased, while 2019 saw an increase in filing alleging cybersecurity breaches and environment disaster, which we'll have a word on just in a few minutes. And 2020 has not been an exception. 2020 has been quite a challenging year for cyber, especially due to the increase in work-at-home trend due to the pandemic. We have seen in 2020 a dramatic increase in the number of incidents and significant numbers of data breaches have occurred in the health, medical, corporate, government, military, educational, and financial services. And we can note that almost every day when we open the newspaper, we can read that such companies have been attacked. Furthermore, while investors used to have a sharp analysis of the financials of the company, we see that they also pay a lot of attention surrounding the cyber. They indeed view cybersecurity risk management as a critical component of the board's risk oversight responsibilities. The consequences of a cyber attack are devastating for the company indeed. High level of costs incurred to recover, business interruption, potential fines, negative publicity, and so on. Moreover, major breaches experienced by publicly traded firms have damaged investor confidence, causing rapid share price drops, and thereby becoming events which give rise to a class action securities litigation. So on top of all costs directly linked to the cyber event, the company and the DNOs can sustain some heavy costs because of the class action. The impact for the company can be tremendous. And of course, as usual, the DNOs are accountable for the protection of the system of the company. They can easily be sued for a failure to institute appropriate corporate governance, for example, to protect against cybersecurity risk. We have already seen a number of class actions against them. We can think about Marriott, Capital One, Equifax, and many other ones. We will now have a focus on the ESG issues that can lead to securities class action also, and for litigation against the DNO. I let now the floor to Amanda. Thank you.
Thank you, Pauline. Good morning, everyone. I'm talking on the fourth trend, which is the ESG-related incidents or claims that are on the rise at the moment. So companies and boards are expected to focus on environmental, social, and governance issues. In general, ESG factors can influence and be influenced by business activities, and if not addressed appropriately, they can escalate into financial risk and hence D&O claims. As ESG failings can cause brand values to fall, and hence we as underwriters look at social media of an insured to look at the reputational views. So we look into that so that we can see how a brand value could or cannot be affected. As we have seen claims coming out from the bad news events, so we have to look at that as well as underwriters. In particular, issues coming from climate change are quite a big ESG factor. Approximately 30 countries at the moment have cases involving major carbon emitting industries, which are, the countries are mainly in the USA. So basically, companies need to adjust business practices in line with changing climate conditions, which is one of the ESG factors, climate control. Another big issue coming from the ESG side of the D&O cover is from diversity. Any company lacking racial, gender, and age diversity on its board of directors, for example, might face lawsuits. So a D&O underwriter would look at how important is diversity to the board of the company that we are underwriting. Also, directors can violate their fiduciary duties with how they treat the diversity issues. One example currently that we can see that creates awareness is that there's been a lot of public attention that has been created by the Black Lives Matter protest. This has caused a lot of public attention, and public attention leads to increased awareness, which eventually leads to D&O claims. I think we can sometimes see that D&O claims come when there's more public awareness to a certain issue. Another ESG issue that we look at is the company is trying to drive change towards a low carbon economy. This is one thing that affects our underwriting and how we underwrite at the moment coal risks. That has a lot to do with the low carbon economy which the world is trying to go towards. So basically, in general, the ESG looks at currently looking at climate change and a lot to do with diversity and the carbon economy of the world. I'll now let Victor talk on the fifth trend, which is private company exposures. Thank you.
Thank you, Amanda. Thanks to you, participants won't be surprised if the D&O insurers ask them about diversity, climate change, and ESG. And now the mega trends number 5, private company exposures continue to challenge. The COVID-19 pandemic is currently placing private companies and their executive under considerably higher D&O litigation risk. But why? Because D&Os of privately held companies are more closely involved in all of the company's operational topics and business decisions. Because in the actual crisis environment, management capabilities are being tested and changing business decisions are required. Because the business decision taken in this time of crisis will have a long-term impact on the risk management practices, internal processes, management of labor, and IT resources. Running a company in these times of unprecedented crisis is not easy. The lack of visibility on the evolution and management of the pandemic is a highly likely source of error for D&O. For a private company manager, the various litigations that originate in the mismanagement linked to the pandemic will have a direct and personal impact. But despite that, the importance of D&O insurance to private companies seems to be generally understated. What are the claims we observe regularly for private companies? The majority of private companies' lawsuits are employees-related matters. However, D&O should not overlook other areas of claims that are on the rise. For example, a private company's officer can be sued for breaching their fiduciary duties, such as in the context of the sale of the company for an alleged inadequate price, A private company's officer have to deal with antitrust claims and regulatory actions. And a private company's officer need to be aware of the potential liability risk under federal securities regulation for alleged misrepresentation to prospective investors and others. They may have a huge impact for the executives who are made personally liable and who lack D&O insurance protection. In the context of the insolvency that we presented in the first round, this is even more concerning. In that scenario, executives are made liable at a point in time when the company itself is unable to indemnify them. Even if for most of you, D&O litigation scenarios against private companies and other executives are well known, D&O insurance to private companies are understated. Management of privately held company need to meet with brokers and insurers to have enhanced risk dialogue in such a way that the inherent and changing D&O risk environment for this business segment is fully understood by all parties. Thank you for listening to me, and I will let the conclusion of the 5 megatrends to watch to Amanda.
Hi, so just as a quick recap of the 5 trends, we first looked at global economic development and insolvency exposure, seeing that insolvencies are on the rise. Number 2, securities class action activities and COVID-19 impact. The securities obviously mainly affected in the USA. Then number 3, cyber attacks in the boardroom increasing, threats relating largely to data breaches. Then I spoke on the ESG factors, which is mainly the climate control and diversity. And number 5, private company exposures, which you see a lot of EPL claims. Thanks. I'm back to Victor on D&O insurance outlook in the market.
Thank you, Amanda, for this great overview. So outlook for D&O insurance market. The brokerage business is not held by the economic environment or the bull market in insurance. On the one hand, the crisis is affecting the clients who are increasing their budget restrictions. And on the other hand, the insurance market is leading by the hard market. And this trend will continue in 2021. For D&O insurance, the profitability of the sector has been hit in recent years due to an inadequate pricing exposure mix and a loss trend increase. The pricing exposure inadequacy is due to increasing competition, growth in the number of lawsuits, and rising claim frequency and severity. And the loss trend increases is due to event-driven litigation, as Pauline previously explained to you, collective redress developments, regulatory investigation, higher defense cost, and more D&O claims being brought in relation to securities around the world. The combination of previous pricing exposure inadequacy and loss trend increases during the soft market cycle continues to impact the D&O insurance market. We can say that the insurance market is still digesting this years of soft market. Add the effect of the pandemic on the economy, uncertainties about climate change, cyber and ESG risk, and you have a very nervous D&O market. But this is still an innovative market where players are exploring different insurance options as increasing retentions to retain much more risk at the frequency and low severity side, co-insurance, alternative risk transfer option, focusing more on the side A part of the coverage and taking more of the side B and side C on the company's balance sheet. More focus on coverages that insurance can provide. Thank you for listening to me, and I leave the floor to Amanda and Pauline to conclude the presentation.
Yeah, thank you, Catherine. You can go to the other one. And the last slide is just around the contact, and we just wanted also to take this opportunity to remind you that at AGCS we not only propose D&O coverage, but also other products. So we also have solution for the financial institution, for which we can propose some professional indemnity solutions, crime, D&O, of course, and also EPL. We can propose the same solution for the commercial entities, for which we also have PTL solution, EPL, crime, and D&O. We just want to draw your attention on the fact that regarding the crime, we have a limited appetite with no more than 5 million capacity. We especially pay attention to the fake president and social engineering fraud exposure. We, of course, have some cyber solution, and AGCS is here to propose you our cyber product. So you will see on the last slide the contact for any question or any submission that you would like to send to. So Amanda is your privileged contact for the FI area, then Motsi for the commercial entities, and then Santo for cyber and PI. So thanks everyone, and we are happy to take any question.
Thank you so much, Pauline, and thank you to all the experts for delivering a fantastic insights of the 5 trends. Currently, unfortunately, I don't have any questions as yet, so I will just want to remind everybody there is a tab for your questions on the bottom right-hand side of the webinar. Please feel free to log on. However, I do have some questions in terms of just wanting to know what the experiences has been like at a local level. So I'm addressing this to you, Amanda, as well as Motsi. Motsi's on the call. He's just been mentioned as one of the underwriters we have here locally. And also, I just want to introduce another underwriter who used to be here in South Africa, Nicole Matheson. She's actually with us on this call. Nicole, good morning and welcome back home, even though it's virtual. I would love to also just gain some insights from you as well. I know you're based in the Netherlands now, but you sort of understand the two worlds. What has been your insights at this point in time, especially with the hard market cycle, that the pricing has gone up? There's been, I'm sure the brokers will attest to this, there's been an issues with capacity. What are you guys seeing, and what is your strategy going forward, especially after having gone through the trends with us? Can I start with you, Amanda? What is happening locally? What have you seen?
Well, we've seen a lot. We've seen a lot of the market reducing capacity, which obviously can sometimes lead to us getting additional submissions because the brokers are looking for additional capacity. And I think all the underwriters are approaching the D&O in the same way, basically, where they're reducing capacity and preferring to see ventilation and looking a lot towards the insolvency due to the COVID at the moment. And there's also a few underwriters, I think, that might be excluding COVID. We do, but we don't do that on all risks. We underwrite the COVID risk and then decide from there. But I think, yeah, in general, in South Africa, most of the underwriters are looking at the exact same thing and reducing capacity. And a lot of them, especially on primaries of D&O, which means that they're having to change structures. So the broker's job, I think, has also become quite difficult. And that's from my side. I'm not sure if Motsi or Nicole have anything to add to that.
So I will just go ahead. So thanks, Senzi. So from what I've experienced from being the South African market when it was starting to harden to moving here during this hard market, is that it's something that's across borders. It's not specific to territories, and it's something where there are more insurers participating on accounts as a result of reduction in capacity. And as the team has already explained with the presentation, there are so many aspects that are being looked at in a addition to it being a hard market in response to the pricing previously noted and now having to be corrected. So there's a lot more involved. And while capacity has reduced and premiums have also changed, I also see that there are changes in the valuation when it comes to coverages in terms of the wording and more limitations provided in that regard. Also, again, in response to the hard market and the trends being experienced with other aspects such as COVID.
Thank you so much, Nicole. Appreciate that. Mats, is there anything you'd like to add, or are you comfortable with everything that's been said? Okay, no, that's fine. Oh, there we go, Mats.
Hi, Sens. No, you know what? Just maybe just in terms of just piggybacking on you know what our experts have also spoken about. I think what's becoming more pertinent and just increasingly important is just the additional information needed now to properly you know dissect risks and analyze risks. I think with a lot of the exclusions that we're seeing you know in the markets, you know it being a hard market anyway, you know, things like your silent cybers and your communicable diseases exclusion. I think these are starting to be viewed more of, you know, more so in terms of a blanket sort of exclusion. However, I just want to maybe just reiterate that I think information is, you know, as I said previously, information in this case would be, you know, key in terms of how companies are dealing with, you know, the internal processes with regards to cyber, and obviously, you know, things like preventative measures for any sort of business interruptions with regards to COVID. I think, you know, information and certain key aspects of how companies are dealing with this would definitely assist, you know, underwriters and just the market, you know, in general, you know, to properly underwrite risks so that, you know, these exclusions can just be, you know, overlooked and so forth and just dissected properly. But besides that, I think it's been covered pretty well.
Thank you, Mats. I appreciate it. So we've got a question under our Q&A, and the question is as follows, guys. Regarding excess layer liability, are you able to facilitate?
Yeah.
Of course,
okay.
Yeah, I go this one.
Okay.
Of course, we want to support the market of the excess layers. But as I said on the outlook for the D&O market, all the market is impacted, and the market hardening is for all layers, not only for primaries. And it's probably also linked to the fact that there is less and less capacity available on the market. And for larger risk, I would say that it's sometimes difficult to renew existing program, and our largest clients have more and more difficulties to find capacity on the market. So even if we want to support it, is not meaning that it is a soft market on the excess layer. It's also a hard market.
Yeah, exactly. The fact is, of course, so we can support placement on the primary if we are comfortable with the risk, and if we can provide solution for the primary, we also can provide solution for the excess layers. But the fact is, as mentioned by Motsi, the information is key, and the underwriting information are key. And we need those information not only when we are sitting on the primary, but also for the excess. And especially we can say that the excess layers used to be quite, I would say, aggressive in terms of rate on line. So we have seen some major increase also on the excess layers.
Thank you so much, guys. And then I've got another question here. It says, whilst underwriters are reacting to the added COVID exposure, have you seen any claims brought against D&O relating to COVID? And if so, what have they been? So are there any claims relating to COVID under the D&O policy?
Yes, so we have seen at the AGCS some claims. So, and the first one came in the second part of 2020. The main claims we have seen in our portfolio are regarding travel and cruise shipment and things like that. So that means that was a very impacted sector. And we have seen, I think, 2 class action in our portfolio. As of today, we have not seen so many bankruptcy litigation, but we expect them to come in the coming months. So we knew that that kind of litigation wouldn't come as of 2020, but more in late 2021 or early 2022.
Yeah, because we still don't know the impact of the phasing out of the measure designed to support company by different states. So this is one of uncertainties that we have as underwriters.
Okay, I have a very interesting question for you guys here, and it says, could we possibly claim against D&O of insurance companies in respect of COVID BI claims? Do you want me to repeat that again?
Yes, please.
Could we, I'm assuming it's a broker or a client, could we possibly claim against D&O of insurance companies in respect of COVID BI claims?
I'm not sure to get the insight of the question. So can we be exposed to a claim because of a BI claim?
Because of COVID? Can a client claim against an insurance company, for example, claiming against the Allianz D&O policies for COVID-related claim, for their COVID-related claim? I'm not sure. So the person who sent us this question, please will you just again get into the Q&A and just elaborate further? We'd love to answer it. Yeah, and then I think I have another question. I'm just going to wait for it. It's coming. Okay, I think that is all in terms of the Q&A. Guys, I'd like to just share with you where you can find the resources or all the reports to the directors and officers trends. You can check us out on Twitter at AGCS_insurance. We have links where you can access the reports, and you can actually just go directly to our website as well. It's all the information is there. Sorry, guys, there's another question that's come up. It says, when does the panel feel that the market will be able to reaccommodate COVID hit sectors again? And this is aiming specifically for the hospitality and travel sectors. So essentially, because we're excluding them now under the D&O, do you feel there'll be a time when these COVID risks may be brought back and accommodated again?
So I must say for that one that it will really depend on the disclosure and on the communication that we have from the company. So we know that we put time to time some COVID exclusion, but this is also an area of risk that we can underwrite if we have enough information. So I don't know if it's okay for the answer.
So what you're essentially saying is the more information you as an underwriter have, the better it is for you guys to make decisions relating to whether the exposure is excluded or not.
Exactly, and we see that the role of the underwriters has really evolved on the last year, because traditionally the main analysis from the underwriters for D&O underwriter was to analyze the financials, because the main exposure was the bankruptcy. Now, as we mentioned, and we are more in the event-driven litigation. So that means that we, of course, need to have a good communication, and we can't have misleading information regarding the financials, but we also need to have a deep look in the ESG exposure, in the COVID exposure, in the cyber exposure, and how the company at the risk management level are treating with that kind of area. Because we have seen that anyone, and especially the investors, pay really a tough attention on that exposure. And we have seen that the clients in the annual report and in the universal registration document are more and more focused on all that kind of risk, and I must say, they communicate a lot more than before on that. And this is really key for us. If we don't have this information, that means that, of course, for example, if we don't have any information on the cyber, even if we are not underwriting the cyber and we are underwriting the D&O, we will put a full exclusion, because we know that a major event in cyber has dramatic consequences on the D&O side. And as Victor has mentioned before, the D&O market is quite tough, and is still quite tough, and all the insurers have had some, I would say, bad results on this line of business the previous years. So if we want to continue to provide some solution for our customers, that we need to adapt, and that we need to have a sound portfolio.
Okay, thank you so much, Pauline. Next question. Does the excess market restrict capacity to the size of the primary layer?
I can answer this one.
Sure.
The answer for AGCS, the answer is yes. The reason for that is we don't want to have more engagement than the primary carrier who will deal the claim on the primary side, and we don't have to have more capacity on the programs than the primary carrier. And so I can speak only for AGCS, but on the market we saw that most of competitors are doing the same. So so this is probably the answer to the question is probably yes. What can I add is, if for AGCS, is if the primary carrier is adding some capacity on the program, it will help us to also provide more capacity on the program.